Yeah, we're completely decentralized. We don't have an office anywhere. We have folks all around the world actually. So from China, India, Pakistan, Poland, Bulgaria, Canada, all over the place. And most of us have never met each other as well. So
Hey, how's it going, guys? This is another episode of EatTheBlocks podcast. My name is Knyck.
And I'm Dro.
We've got a very special guest in the building tonight. It's Michael Bentley from Euler Finance. Thank you so much for hopping on the podcast today.
yeah, thanks for having me. Great to be here.
Yeah, 100%. Where are you calling in from? Where are you located?
I am in Leeds in the north of England, actually.
Hey,
Kind of
awesome.
an unusual place.
Super cool. Yeah, I definitely want to travel to Europe this, summer sometime, try to find my way out there. So maybe I'll check out Leeds along, like on the road.
It's like Game of Thrones, like you get
Yeah.
closer, you get north of the wall and stuff. It gets grim. That's
A couple dragons from time to time. Yeah, for sure.
yeah. Maybe if you fuck around. No, we've got some nice countryside here, but yeah, it's.
I would
I'm
even
not sure you'll make it up here.
Leeds for Leeds United. I'm a Bielsa fan, so
I'm a big Leeds fan. Yeah,
yeah,
I was
hey,
gutted.
let's go.
I can't believe he got sacked recently, and I was absolutely
Yeah.
devastated. Yeah,
I
really
followed him
sad
for a
about
while. I saw that news. I wanted to ask you. Now that you said Leeds, I was like, I wasn't sure if he was into it or not, but that was big. So
Yeah, I actually went to his last home game. We
Mhm.
played Man United, who are our biggest rivals,
Yeah.
and we got beat.
Oh
We got beat
no.
4-2, but yeah,
Yeah, you
cool.
win some, you lose some, win some, you lose some.
Yeah.
Yeah, so thanks so much for hopping on. We would love to know about. We want to dive deep into like Euler and sort of like the things that are benefits. Sort of about your competitors. But would love to start with you and sort of your history. What's your background? How did you get into the DeFi space?
So before doing this, I used to be an academic. I used to work at the University of Oxford, and my job was I was an evolutionary game theorist. So I used to
Nice.
work with yeah, like an evolutionary biologist. So I used to be on the theory side of things, but work with a lot of biologists and computer scientists and sometimes physicists and others, looking at complex systems,
Yeah.
so natural systems.
Yeah.
They're often sort of heavily optimized, very robust,
Yeah.
and try to sort of dismantle them and take them apart and try to figure out how they got to that, how did they evolve to that state.
Yeah.
Um, so
That's
yeah,
so interesting. People always talk about biomimicry in the fields of like mechanical engineering or maybe in like material science, but you don't think of it as often in in the concept of software or developing of like types of things in DeFi. How do you think how did that inspire you to get into DeFi? What were those steps like? When was the first time you heard about crypto or like blockchain or anything?
So the first time I did a PhD, and the first time was probably in the last year of my PhD in 2015. Someone sort of tried to introduce me to it, who's still in the space now and runs
Nice,
a successful auditing company actually. But
cool.
I was very skeptical when I first heard about it. I've got to be honest. My initial reaction was skepticism, so
Hmm.
I kind of dismissed it. And then in 2017, there was a big bull run, and I'd finished
Hmm.
my studies by then and had a bit more time on my hands. So I started building, trying to build trading bots. I thought I could beat the system by building bots and trying out automated trading strategies on actually on sometimes on like the first rudimentary dexes. Um, and yeah, of course, I like everybody else made and then lost all the money that I made from trading during that period. Um,
Of course, yeah.
and stuck around. Really, I just at that point I kind of got hooked on the on that side of things. But then there was a lot of rubbish projects around at that time, but
Mhm.
there were some really good ones that came out of that period and stood the test of time now. And yeah, I stuck around and just started getting more interested in Ethereum in particular.
Mhm.
And by 2018, I was doing hackathons and little coding projects and so on. And yeah, 2019 came along and I started taking them even more seriously. My wife and
Mhm.
I we're about to have a baby, and so I started thinking, oh, I'll try and win a coding competition and get some prize money, and that'll help pay for costs and all that kind of stuff.
Yeah, that's awesome.
Oh, I love that. I love to hear how your development journey started, because we know each other from college, right? So he has his engineering background, and I was learning in tech. Ended up working like IT stuff, but today, 2022 is the start of my development, like my development path, right? I've worked in like tech support, test engineering, and project management, but never have I had to make my own app, build my own thing. So to hear how you kind of made that transition, it was through your interest. It's very similar to mine. I got into the crypto rabbit hole, and suddenly I just felt like I want to build something.
Yeah, yeah. It's that urge, right? And unfortunately, on the internet today, you can just learn anything for free, right? There's so many talented YouTubers and other resources out there for people to access, and that's all I used to do. I used to sit on a night time and watch YouTube videos and run through tutorials, and that's really how I started getting into it, to be honest. So congrats on the start of your journey. Hopefully in a couple of years' time, you'll be launching your own DeFi protocol.
And when did it become, for you, very real? I like to use that term because I feel like a lot of people who are transitioning into Web3 in general, they have this moment where they have their Web2 life, they have that pre-life, and they see this new world opening up, and they want to participate, and then they want to actually lead, which is something that it sounds like you've made that transition. When did you feel that you were ready to make that, and you made the decision to do that?
It was middle of 2020. Honestly, when I started, the project, initially I was just doing, so before I got into DeFi, I was kind of interested in NFTs and thinking about building a fantasy football-based trading game.
Oh,
So
cool.
something a little bit like SoRare. So I was working on something like that, but I wasn't making a huge amount of progress. And then in early 2020, Compound Finance came out, one of the big lending protocols on Ethereum, and I thought it was super cool. They'd been out for a little while actually, but I first heard about it then, and I had some ideas for my day job about how to optimize their interest rates. So I just started. That's how I fell down that little rabbit hole, and then it just started to grow and become more and more real. The hackathon organizers started connecting me to other people. They thought I had this cool idea, and so I started speaking to other builders in the space through this hackathon who also were interested in trying to build a lending protocol, but for other reasons. And I think it was around August time where I had this. Oh, excuse me, sorry, something's just come on here. My fan. It's actually quite cold here, so I've got my heater coming on. I'll sit in the cold. It's fine. We had. We were starting on this. What was I going to say? Yeah, we were starting on this project together, and around August time, it was clear that this little simulation and this sort of rudimentary lending protocol that we kind of hacked together was attracting some interest from other parties, and so the hackathon organizers, who we would go on to collaborate with, they actually started introducing us to venture capitalists, and that was a whole new world of folks that I'd never met before, a whole totally alien world to me. But we started talking to them about it, and it suddenly dawned on me that there might be something in the idea that we could take forward and make it into a fully fledged project. So by September, we'd actually registered our business, and we started on the path then. So it was right at the end of August 2020, right in the midst of DeFi summer, when everything really started taking off as well. That we sort of finalized our first sort of seed round of funding and took off there. So I had about 2 weeks to go and tell my boss that actually I'd just gone back to Oxford and signed a 3-year contract with them, and in less than a year I had to tell him that I actually was going to jump ship.
Oh man, that's wild. So I saw that you mentioned investors. I saw that you guys have Paradigm and a whole bunch of other investors that have sort of joined on. What do you think is the most helpful part? How do they add value, and how do they sort of help you out day to day, or even quarter to quarter?
All really different ways that they add value. Some more than others, of course. Some are more passive, some are more active. And at different points in the development cycle as well. Sometimes you want to really speak to a builder who's been there and done it before, and then we have some angels and some funds there that can connect us to other projects who really can just give you that advice. Sometimes there's just like loads of stuff you don't have any idea about, like the legals, financials, mechanism design. We've had a bunch of help. Hiring has been really important as well. It's really challenging to hire in Web3 right now, and hiring a team of people, it's really tough. So getting those connections together and hiring good people, that's been really probably one of the most important things for the past year, I think.
That's exciting. You mentioned hiring there. There's two things I was wondering about. So the first question is, how did you meet your co-founder, and what were you looking for a co-founder, or what qualities do you think are important in a co-founder?
So I've got two actually. So we've done that.
Nice.
We've got three co-founders.
Three musketeers.
Yeah, which I know they don't advise, right? Because you always pick sides. Really it's like having your favorite kid, right? You're not allowed to do that. I met. So there's two co-founders, Jack and Doug, and I met Jack first through the hackathon. He had a totally different background to me. He's very sort of hands-on builder, full stack developer, and so I came in with more of the like Ethereum mechanism side. There, so we kind of worked nicely together because we had different skill sets, and I could be building out the ideas for the how the lending protocol and its core would work, and he could be there building out the website and building out that sort of functionality. So
nice.
we gelled really well together. One area that we quickly realized though that we needed additional support was on the smart contract side of things. I've had quite a lot of experience doing programming different languages, but I'm not a professional computer scientist, obviously, and I realized very quickly when I started learning Solidity that there's so many pitfalls, and you really have to be an expert to be able to write secure smart contract code. So I was going to take it on myself at first, but it quickly became apparent that maybe wasn't a good idea. So we started to
when you call it a pro
people.
Exactly.
And there was another guy on Doug, who's our other co-founder, who was he was in the hackathon as well. He'd actually done some, rather than some flashy project, he'd done some really sort of like nerdy command line tool for people building out smart contracts. And it was apparent that he was really, really top tier smart contract developer. So we gelled really quickly, and that made the team. There was three of us with three different skill sets. So I think that's important to be able to have those different skills that you can so that you can specialize in different areas of the operation.
Yeah, no, that sounds so cool to hear you explain that relationship with your first co-founder that you talked about, because sometimes I'll text Knyck at like 2 a.m. and I'll be like, hey, do you have an idea for me to like try to build right now? Because I want to like build and everything, and this guy just has millions of ideas rolling in his head. So we can relate. We can relate to that dynamic of kind of going off of each other, spitballing ideas, using his strengths, our strengths. And so, that's cool to hear that that's kind of like a same situation you guys found yourselves in.
Yeah, it's really important to have that those different characteristics. Like Jack's got all the energy, like you say, and just get stuff done. And sometimes he'll be the first to say as well, sometimes he just gets it done and it's not perfect. And I had the opposite. I would sit down, and if you just left me to it, I would never finish anything because I always want perfection, and I don't care how long it takes. And so it's nice to have to be able to sort of balance each other out in that way.
Cool. So it's September 2020. You guys team up, right? The super team just made. Where is the team now? Like, how big is the team? Is it completely decentralized? And what sort of the composition? Is it mostly engineers? Or like, where are you guys growing right now?
Yeah, we're completely decentralized. We don't have an office anywhere. We have folks all around the world actually. So from China, India, Pakistan, Poland, Bulgaria, Canada, all over the place. And most of us have never met each other as well. So only a few of the team get together every now and again. Obviously, it's challenging. We're all meeting as an entire team next month. There's a big
That's cool.
blockchain event in Paris, so we're all meeting.
Nice.
Yeah.
That's gonna be good. That's gonna be a good
Yeah.
link up. I love to see that. And you said majority of the team is like engineering focused right now. You guys are really product focused at the moment.
Yeah, we are. That's right. It's there's a lot to do, so it's I think you have to put the product first and have, especially in DeFi, you have to get security and get the product right before all the marketing comes. You see a lot of projects try to sort of lead with the marketing, but it's really hard. It's really one of the things I've learned most is really hard to predict how long things will actually take, especially when you're working with third parties like auditors and so on. It's really, really hard. So yeah, we've been growing the tech team constantly at a nice steady pace, so that we add people, they get time to adapt, then we add more people, and give people space to kind of find their niche within the organization, and then keep growing. So I think in the long run, we're going to need to bring on board more people with more sort of soft skills and more marketing business sort of side of things, because it's not a skill set that we necessarily have. Great skills within the team, but we're working on that as well.
For sure. That's super exciting. I wanted to check in with you and sort of see. So we're getting into talking about the product. So what is a lending protocol on the most basic level?
So on a really basic level, it's a place where people can lend and borrow crypto assets to one another, and most successful lending protocols in crypto now use something called a peer-to-pool model. You could lend and borrow in a peer-to-peer way. I could go to you, Knyck, and say, "Can I borrow some ETH?" And you could say, "Sure." And we could come up with
You're like, "No, my pockets are low right now."
come up with a payment plan. You tell me how, you charge me an interest rate, come up with a payment plan, say I've got 6 months to get it back to you or whatever. But it's super inefficient, and it just doesn't really work. And another big project called ETHLend that's now Aave tried that several years ago without much success. So most lending protocols, Euler, Aave, Compound, all of us use the same type of fundamental model, which is one where lenders essentially deposit assets into a single pool, and then borrowers take assets from that pool. And essentially, the more borrowing there is from the pool, the higher the interest rate goes. Obviously, if there's more borrowing, that reflects the demand for borrowing, and that reflects the cost of borrowing should go up. And so all projects use that fundamental core to guide things, and it's very nice because it completely disintermediates the lending and borrowing process. You don't need a bank setting rules. You don't need a controller setting the interest rates. It's all automated and all fully permissionless. So it's a very elegant, efficient design, and ultimately the interest rate for lending and borrowing will float all over the place, all over all the time, which is probably one of the trade-offs. But ultimately, the big win here is that anybody anywhere can lend or borrow from one another all around the world, which is orders of magnitude more efficient than anything you see in traditional finance, I think.
Nice. Cool. So our next question then, after that wonderful explanation, because I just learned a lot. Your abstract, I love the way you guys describe it. A permissionless lending protocol custom built to help users lend and borrow more Ethereum-based tokens than ever before, right? And the way you described it, that totally makes sense to me now. What makes Euler unique?
So I think we've got lots of innovations that we can dive into lots of detail if you like. But on the top level, one of the first things that we worked on was permissionless listing of new assets. So a lot of existing lending protocols will allow people to lend and borrow just a handful of the most popular tokens, essentially, including stable coins and ETH. Among other things, which leaves this whole long tail of the market essentially unserved. And one of the things we wanted to do at Euler was to democratize that process of lending and borrowing further and allow people to lend and borrow almost anything that's based on Ethereum now. And that's really challenging. I mean, you have that already in place with trading tokens, like on decentralized exchanges like Uniswap, but doing it for lending and borrowing is really, really tough because there's lots of additional risks involved. And lots of these tokens can be really volatile, they're illiquid, their prices can change a lot. And all of that can really unsettle a lending protocol if you're not careful. It can leave lenders with bad debts. It can leave the protocol with bad debts, which means that the lenders essentially miss out and end up losing some of their assets, which nobody wants. So to solve this problem, you have to work on mechanisms that essentially mitigate risks associated with these really illiquid and volatile assets to try to keep everybody safe. So that's one of the big selling points on Euler is that we have this extensive risk framework that focuses on allowing people to lend and borrow almost any Ethereum token.
Got it. Yeah, I was looking into sort of like your risk like management and sort of like how you guys are approaching it. And I thought there was a lot of interesting sort of approaches that you're taking. Could you sort of explain how you guys sort of manage to avoid any sort of issues with liquidations? I was saying stuff about sort of the Dutch auction approach that you guys use. I thought that was pretty interesting. I would love to hear more about it from you.
Yeah, sure. So firstly, what happens in a liquidation on a lending protocol? Why do liquidations take place? Usually, on most lending protocols, you are required to be over collateralized when you're borrowing, which means that you have to put more value into the protocol than you take out as a loan. So you might, for instance, deposit $1,000 worth of a stable coin like USDC and then take out $800 worth of ETH, for instance. So that's the first point to make, and the reason that's a requirement, of course, is that we can't just trust people to repay loans in a permissionless environment. It's not a lending protocol like that's not going to last very long. So you have to actually enforce that people always are in a position to be able to settle their loans at the end of the day. So you require this over collateralization requirement. But of course, prices aren't static; they change through time. So your $1,000 of deposits might not be $1,000 tomorrow, and your $800 of borrows might have increased. They might be $900 tomorrow. So typically, what lending protocols do is once if you take your over collateralization requirements, as these two things get closer and closer together, there's a point where the protocol suddenly goes, you're at risk here of not being able to repay the loan. So what I'm going to do is let anybody from around the world come in and essentially repay this loan on your behalf. And I'm going to do that by letting them swap your collateral for the asset you've borrowed, repay the loan. And the liquidator, why would a liquidator do this? Why would anybody around the world do this? They're not doing it out of the goodness of their heart. Usually they're given essentially preferable rate on the exchange of those assets. So they get a little bonus for performing the liquidation. So that's the principle of it, and it's a really elegant design. I think probably Compound came up with it originally, and I think it's very simple, elegant design in principle, but it does have some big problems. Actually, it emerged whilst we were building Euler. So one of the big issues here is that if you're a massive borrower, let's say you've borrowed $1 million worth of something. Usually the discount that's given to the liquidator is some fixed percentage. It might be 5 or 10%. And so if you're borrowing millions of dollars worth of assets, then sometimes these bonuses that get paid to the liquidator can be tens or tens of thousands of dollars or more. Of course, that's really punishing for a large borrower. And of course, it's really excessive as well in terms of the liquidator. You probably don't need incentivizing with tens of thousands of dollars to go and perform a liquidation, right? These things aren't that expensive to process. And if you have the code written, they take no effort at all, in fact. So what happens in these circumstances is therefore that you inhibit borrowing from the outset because large borrowers don't want to get punished this way. If large borrowers do get liquidated, then you'd imagine the liquidators are really happy. But in actual fact, on Ethereum, that's not really the case. What usually happens is that if say us three are going in for this liquidation to try to claim it, the way that we can try to do to claim it for ourselves is to try to front run one another. And a common way of doing that is to bid up the gas price that we're prepared to pay for this transaction. Exactly. So you pump up this gas price, right? And if there's tens of thousands of dollars on the table, then you're not going to be you're not going to be edging up that gas price, little by little. You're going to go crazy, right? You're going to be like, okay, well, I'll happily take $5,000 for this liquidation, and then someone else goes, I'll take 4. And eventually, of course, you have this English style auction where the gas price just gets bid higher and higher and higher, and most of the liquidation benefits actually end up going to the miners rather than to the liquidator themselves, which is not good. So on Euler, to solve this, we do a few sort of tricks to try to settle things in a more efficient way. We flip things around, and rather than have a fixed discount of 10%, we actually let the discount start at 0% and then rise as the position of the borrower gets more and more unhealthy. And what this means is that the market now has a say in what that percentage discount should be. It's now, the auction is no longer an English auction where we sort of keep bidding higher and higher. It's now a Dutch auction. It's basically who grabs the opportunity first. And of course, we all want to wait for a larger bonus on this liquidation, but it's a game of chicken. One of us is ultimately going to go first, and if $1,000 is on the table, for instance, I might happily take that. So I jump in at $1,000, which means that the percentage of the original loan that's given as a bonus can actually be, a fraction of a percent. It can be 0.5%. It can be tiny. It all depends on the gas price on Ethereum at the time and everything else. So we really give the market a voice in what the real percentage discount should be, depending on how big the loan was and the environment at the time the liquidation was processed.
I did. You were mentioning before how you did a lot of game theory stuff within your PhD. I did cognitive science and focused on behavioral economics, and this stuff, talking about these types of incentive structures, is so interesting, so fun. To me, I imagine it's super interesting and fun for you as well, designing these processes and figuring out how you can make it so that these large systems of non-coordinated actors can actually work together and make a system like this. So that's super cool to see the way you guys designed it.
Yeah, and I'm sure you mentioned Compound, for example, right? You mentioned other protocols before too, and some of the things that they didn't address, but it did sound like they paved the way a little bit for this to come up, right? Can you speak on that and what you learned from other protocols, how what they were doing when they were trailblazing, and then the questions that they didn't answer, and how you guys went about trying to answer those questions in your protocol?
Yeah, I think we're at a point now where anybody building in DeFi is probably standing on the shoulder of a giant somewhere that actually did 90% of the work, and we're all sort of now fighting to optimize these sort of core designs, I feel, for the most part. So we've seen this with decentralized exchanges as well. We're now at the iterative improvement point and thinking about specialist products for certain scenarios rather than thinking about core general products. I think Compound in particular, just the idea and the sort of audacity to bring that kind of protocol into existence. It's just I'm in awe of the team for them doing it. And what we've tried to come in essentially is take apart their work, break it down to its bare bones, and build it back up again with optimizations that we could think of as a team. And so that was our process, and things like the liquidations. I think when you're building something for the first time, of course, it's always good to go for something simple that that's going to work and it's going to be clean. And it did work on Compound for a long time, and some of the issues with it have only become apparent over time as the ecosystem's developed. So it's I think we've in terms of that standing on the shoulders of giant stuff. I feel like that's what most of us now that are launching products are kind of doing is paying homage to these rock stars that brought these very first generation protocols into existence.
Nice.
It sounds like you guys are. It's like a mad science lab experience. We can build them better, stronger.
I feel like you were mentioning before that you're sort of building more specialized products. I would love to hear about who are the current users and who do you see as your future users? With how many people, how many wallets have you seen that have connected, and sort of how do you think about that user growth?
Yeah, lending protocols. Some people call them liquidity protocols because they kind of sit at the bottom of a stack of other protocols and provide liquidity for the rest of the whole DeFi. The types of users you have are very varied. I I think probably, for me, the most important ones are the borrowers, and they are the folks that are actually generating the interest that gets paid to lenders, which incentivizes them to deposit assets. And so, who are people that are borrowing assets, especially in an over collateralized way? Because in some sense, it's quite an inefficient way to borrow something. You have to put in more value than you're taking out, and a lot of people's initial reaction is, "Well, why would you ever do that?" And there are lots of reasons. Some of the main ones, of course, you won't be surprised to hear, are that people trade with these things. So you start with a stable coin, and you then go away and borrow something that's not a stable coin, like wrap Bitcoin or ETH, and you can then essentially go out there and trade with it on markets. You can market make, you can arbitrage on decentralized exchanges. You can hedge positions elsewhere in the ecosystem. You might have a position that you've just taken up on a centralized exchange. You can then hedge it on, hedge it on chain. You can go short or long with assets as well on a lending protocol. You can build up leverage positions. So on the borrowing side, it's usually, I would say, DeFi native sort of pros, DeFi native hedge funds, that kind of thing. A lot of market makers use lending products. And ultimately, it's that trading activity. It's people taking advantage of opportunities in the market and making lots of profit from that are then paying a portion of that yield back to more passive participants that are the kind of ordinary lenders. And on the lending side, you have a range of folks as well, but you tend to have a much larger number of people on the lending side of a protocol, maybe 10 times as many lenders as you have borrowers. They don't always bring the same sort of size to the protocol, and they often have very different behaviors. So they'll typically want to deposit assets, leave them for a year. They're very happy holding on to them, but they make them productive by putting them on a lending protocol. They can come back in a year and earn 5, 10 or more % interest on those non-productive assets, and sort of earn a yield on them. So they're the two big use cases, I think.
Cool.
Super interesting.
Yeah, it's really cool.
Yeah, I definitely would love to hear a little bit about what is one of like your favorite thought process around like managing risks, because there's so much. I don't know what your current TVL is, which is for all of our newer listeners, total value locked, which is overall value of the crypto assets deposited in one of these protocols. Does that get stressful, like on a personal level? You have so much that you're responsible for? How do you guys think about risk? Is it like bug bounties? Like you mentioned a couple times, like audit firms. I've heard of a couple different audit firms, or is it like sort of does a large portion of your team focus primarily on security? How do you guys think about these things?
Yeah, we had. We took ages to launch our protocol, partly because we were thinking about risks obsessively all the time. We spent a lot of time optimizing parts of the code and really, thoroughly testing every component. So we definitely, I think one thing to say is we didn't rush to market. It took us around 18 months before we really came out and launched on mainnet, which is quite a long time for a DeFi protocol. A lot of folks were sort of build fast and break things philosophy. And I can respect that as well. But it's not really in the DNA of our team. We're sort of quite slow and considered. So that's how we've been thinking about it mainly, is just go slowly and carefully, and think about things as much as you can along the way. We've done had a lot of audits on the code as well. So we've had I think 5 different auditing firms we've worked with, who all bring a different sort of style of auditing to the protocol. That's important. We get help from collaborators and folks on the way. There's some really talented people that work at Paradigm that give us tips and check things out for us and answer questions. That's really useful as well. And then bug bounties. That's another big one. Before you launch, or whilst you're in the early stages of launch, just putting out a big bounty and saying, "Please don't hack us. If you do find a bug, report it."
Come at us.
That's it.
That's awesome.
I think that's really important. Again, it comes down to incentive structures. If you're somebody that's found a bug in a protocol, do you want to? You could maybe hack it for 10 million, or as a black hat, or you could do it as a white hat and earn $1 million, but not have any risk of going to jail. So those incentive structures are important. We're also an insured protocol, so we have a partnership with a another DeFi project called Sherlock.
Mhm.
They've actually both audited and insured the protocol at the same time, which is, again, quite cool for incentive structures. It means that their devs only get paid if we don't get hacked. If we get hacked,
So interesting.
Okay.
Wild.
we get
That's so
hacked, they have to
cool.
pay out an insurance claim. Then that's the devs lose some of their pay, I gather. So
That's wild.
yeah. And then once you launch, of course, it never stops. You know, you're constantly
Yeah.
optimizing, constantly on the hunt for new things. And
Mhm.
but one of the nice things about DeFi, I suppose, is that if you've survived in one of the most hostile environments for an app on the planet,
Yeah.
where you have this big honeypot and you have all these nasty actors out there trying to raid that honeypot, and your code's public and it's visible. You can't hide. It's not security through like obfuscation that you would get in a traditional finance product. You know, you're there, you're very exposed. If
And
you
look at
do
it now.
survive for a long time, then it's a really good sign that actually the protocol is robust and secure. And that's what I really like about DeFi, is that through this kind of hostile environment, we actually, through kind of a process of natural selection,
Yeah.
we actually select for the best practices, the best security practices on Earth, probably in the long run.
That goes back to the natural systems from before that you were talking about. That's so interesting.
Yeah,
Exactly.
no, I just love hearing a team talk about
So cool.
taking their time with building, because in our space in Web3 and everything's so fast, and it's great to fail fast, right? Like if you work at a startup ever, or just a very a good environment at a big corporate Web2 company, a good culture to have is failing fast and
Yeah.
building off that, learning your lessons and improving on it. But to hear a team that said, look, well, we want to build, but we want to build the right way. And especially in something so risky as DeFi for others, people look in the news and see everything that's happening. But to hear that a team said, we're going to do this right, we're going to survive, like we'll be through this natural selection part, we'll come out the other way alive. It's really refreshing. And to hear your insight on like how you guys made that decision as you were going, right? Hearing the growing pains a little bit, and knowing that the relationship you had with your first co-founder and your other co-founder, of you want things to be perfect and he wants to build. I think it was a nice context into how things happen for you guys.
Yeah, I wanted to ask something else that stood out to me. It was the Oracle Attack Simulator. Could you go into a little bit about that, why it's important and why it's sort of a new innovation?
Yeah, sure. So the on Euler we have all these assets, and you have to know the prices of the assets at all times so that you can say, does is somebody violating their loan conditions, for instance.
Okay.
So you have to get a source of truth for those, for the prices of those assets. And on many projects, they'll use a third party provider to give those prices, and so they'll have a team of people who essentially take prices off chain on other exchanges and put them on chain, and give you those sort of price feeds, which has proven to be really successful. Things like Chainlink have been holding up billions of dollars worth of value in DeFi as a whole. But one thing they're not good at is providing services for longer tail of the market. And so a type of oracle called a TWAP oracle emerged on decentralized exchanges. And what they do there is
what does TWAP stand for?
It stands for time weighted average price.
Cool.
And so what you would do with a TWAP oracle is you, rather than take the price just right now as it stands, you actually take the history of recent prices and you take the average of those recent prices. And why is that important? I guess is a good starting question. The reason is that manipulating the price of something at this instant is actually fairly easy to do. You can just drop in a big transaction for lots of money, and you'll move the price there and then, and you'll move it on this particular exchange, on decentralized exchange or wherever else, right? If you just dump like $10 million worth of Bitcoin, well, maybe not Bitcoin, but some markets,
something small,
if you take the average price, what will happen is actually that kind of one the impact of your trade, which will probably usually be arbitraged back really quickly. So somebody will take advantage of that price change and restore it back to the market average across all the exchanges. It will kind of be washed out by the average. If you just take the current price, they'll have this big price spike. The longer you average for, the more you kind of wash out that like noise basically with the main signal, which is the average price over time. So that's the theory anyway, and you can get average prices, these TWAPs, from Uniswap. But it emerges that on Uniswap, especially on the version 3 of Uniswap where we take our oracles from, there's still some potential issues with manipulation. And the reason for that is that on Uniswap v3, liquidity is concentrated. And what I mean by this is, like, imagine if you were trading on an exchange and there was no order book at all. There was just a price. There was just a single order just above and just below the current price. You'd have liquidity really concentrated on that order book, right? To move the price, what I could do is essentially sell into that liquidity. Once that liquidity is gone, I then have like an infinite drop or an infinite rise, right? Because there's nothing else on the order book. So it might take me, quite a lot of money to move that single order, but beyond that, a single dollar could essentially drop the price to absolute zero or move it to, some like infinite value. And so the potential for this to happen on Uniswap v3 means that even these TWAPs can be vulnerable, because if you take an average of something, especially the type of average they use on Uniswap, and you have a zero in it, they use a geometric mean averaging method, which involves multiplying all the values. And if you multiply, so if you multiply lots of values together, and one of those values is zero, then the whole product will be zero. And so potentially there's a manipulation opportunity there. So what do we do? What have we built? You want to know, firstly, you want to encourage projects that are using oracles from Uniswap v3 to try to fix this, and they can do that essentially by providing small amounts of liquidity to the entire range, and that helps short the oracle, because it means there's always an arbitrage opportunity there if the price is manipulated at any time. So it makes it really hard to do this attack. But to actually know if that liquidity is there or not, what you actually have to do really is you have to simulate one of these trades, and that's what our attack simulator does. It says if Knyck, I was to drop $10 million worth of curve onto the market now on Uniswap v3, what would happen to my TWAP price? Would it stay the same, or would it be dramatically reduced? If it's really impacted by a $10 million trade, then we would say that oracle isn't very secure. It's not very robust to price manipulation. If, however, we simulate this trade and it turns out that $500 million is required to move the price of curve TWAP on Uniswap v3, then we can conclude that it's probably fairly unrealistic that that's going to happen anytime soon. So that's what the attack oracle, the simulator, does. It lets you sort of pretend that you're a massive whale for a very small instant, and then you can move markets with huge amounts of funds, and it will actually process that trade on chain using a static call to the Ethereum blockchain, and it'll simulate the trade for you. You can see whether or not you're likely to be in trouble using one of these oracles or not.
Oh, so cool. Yeah, you could pretend to be a whale for a day.
It's a whale cosplay. How did you guys come up with it? Was that a team effort? Were you guys bouncing the idea around? How did you guys get to
that? For us, well, we knew we were going to use these oracles, and we knew that there was that whenever you use anything in DeFi crypto, there's always trade-offs. And as I said, the Chainlink oracles have some big advantages, and the TWAPs ones do as well, but this is one of those trade-offs that we were just aware exists. And of course, you need to tell people about this when they're about to lend or borrow something. They can make their own minds up, right? That's the philosophy of DeFi, is show people what the risks are and let them make their own decisions. Ultimately, nothing in DeFi is risk-free. There is no such thing as a risk-free trade or DeFi protocol or anything. But you need to be able to make an informed decision about that. And so if we tell people, look, it'll cost 20 million to move the price by something, you can decide, well, I'm only depositing $500. I don't really care. That's not going to happen.
Mm.
Or you can say, well, I'm depositing $1 million. Maybe I don't want to mess around with an oracle that's only secured by up to 20 million. So that's not what it's about. It's about giving people a chance to evaluate risk for themselves.
Yeah.
You know what's cool about that I hear that you guys thought about that? It's a great tool, right? And your decision was to make it available. A lot of times in the old world, that's a trade secret at that point. They're keeping that in-house. They're not telling anybody about it. They're using it just for their product. It's really cool that you guys saw this too and said, no, let's put it out there.
Yeah, we have seen these kind of attacks, unfortunately, happen on other DeFi protocols. And I think DeFi is probably only going to survive in the long run if we look after each other. We have friendly competition with other protocols out there, and competition is a good thing because it drives innovation and so on. But ultimately, the bigger picture is that we want DeFi as a whole to be successful, and it's still such a tiny part of the financial system. And for it to grow, we're going to have to look after each other. And obviously, we want to look after people that are using other protocols as well. So it didn't make sense to us to try to keep that in-house. It's out there for anybody to go and have a play with whenever they like.
It's really cool.
Awesome. Thinking about, I guess, risk in these managed ways, how do you guys think about? I mean, obviously, you can't prepare for a black swan event. That's the definition of it. But how do you guys think about these things? I feel like they would just stress me out. I feel like every day is less precedented than the last. What's sort of your approach to managing those kind of things?
I guess we do a lot of things. On a personal level, it does stress me out, of course. Yeah. Especially the first few days after we launched, I was really, really nervous. Like I said, because of the nature of the system, where once you've been out for a while and you've had this honeypot, if no one has taken it, it becomes a growing indicator that it's actually not possible to hack the system. But it will take more than a year for me to start to feel
a little bit longer,
sure. But we do have just saying about open sourcing stuff in house. We do have a team that essentially simulates weird conditions on Euler specifically, and the wider market, so that we try to think about what it might look like if there was a black swan event, and that can be really important for setting parameters on the protocol. So, for instance, saying how much do you need to over collateralize by on each particular asset. I think in the long run, not just us, but other participants in the ecosystem are going to have to help make these decisions and contribute to lowering risk on not just Euler but other protocols as well. But that's one way that we deal with it, is try to imagine the possibilities before they happen and try to simulate them and see what percentage of time does a bad debt scenario arise if you set certain types of parameters.
Cool. You guys it feels like you guys are constantly thinking about the space, looking at competitors, working together, and where do you see what's like making you scratch your head right now? What's like, what are you looking at and you're like, we don't have a answer for that yet, but it's a gray area and we want to sort of attack it in the future? Do you guys sort of have like a roadmap or sort of things that you want to develop in the future that you think is going to really dramatically change the space?
For Euler, we do have I suppose an internal roadmap. We try not to make public ones because you just never stick to them
at the time.
They're just a nightmare for that reason. So I think layer 2 stuff is really important for scaling, and that's something that I'm really excited to see. I'm shamefully don't know as much about it, about the underlying technology as I wish I did, because I just don't have time to go in and dig into the details.
You're too busy already.
You're doing a lot, man.
I'm really excited about layer 2 scaling and seeing how that takes off in the coming year, because it does seem to me that mainnet will become a kind of base layer where you have these big sort of settlement transactions taking place, and that most of the trading and the speculation will move on to layer 2s where it's cheaper. And ultimately, for a lot of traders, if you're mucking around, trading $1,000 worth of shit back and forward, it's probably okay to not, have one of the world's most secure networks backing that up. You probably can handle a bit more risk and go on to some layer 2 with maybe a slightly decreased security model. So hopefully that will help Ethereum continue to scale. Really excited to see that kind of stuff. I'm interested in privacy solutions as well. So stuff like Aztec, seeing how that develops. Privacy is a weird one because, right now a lot of the solutions just tend to be used by bad actors, right? And so there's a bit of a reputational risk around privacy, but ultimately it's really important. And I think we need to normalize people having, access to private transactions and having their finances kept private and not made publicly available to the wider world. Like the stuff with the stuff going on at the moment, those discussions about regulation and visibility and all the rest of it is one of the trade-offs of the blockchain that I think a lot of people outside the system don't realize, is that everything is public and it's there forever. So that can be both a good thing and a bad thing depending on where you are in the space.
No, that was one of the first topics we discussed on this podcast, was the idea of how far are we decentralizing, and at what point does privacy kind of come into play. Like, you do a transaction, it's on the blockchain forever, everybody can see it. But you're right, I mean, privacy is such an important thing for people for whatever reason. Everyone has their own reasons for it. And we discussed early on, that balance that will need to be found in the DeFi space, in crypto space in general. There is definitely a demand for privacy. We see it and outside of this space in everyday life, right? People don't want anybody in their business. So it's no surprise that this is a question that's going to have to be answered in this space later. And it's interesting to hear how you guys are thinking about it.
Yeah, it's going to be a difficult conversation because there is this reputational sort of issue that we have at the moment with people who use privacy solutions. If I send some money to Tornado, people are going to go, well, why is he doing that?
So what does he have to over there?
Right? People are going to have questions, and that's unfortunate. I hope we can normalize access to privacy, and the world is getting less and less private as a space, as a place. So I think making sure that we preserve a little corner for ourselves where people can't just pry on us, I think is really important. But I'm also not sure how we're going to get there. Really intrigued to watch how all that stuff develops. The other big technology piece I think I'm looking forward to seeing is options and how they develop on Ethereum and layer 2 stuff as well. It seems like you need layer 2 to make options work really well, but I think that's going to probably take off in a big way in the next year or two.
Super excited.
Oh, you heard it here.
Yeah. I heard it first. I mentioned before TVL. Are you guys like, is that open? Do you guys share that? And what's if that's not your lead metric, what is it? Users? Do you guys have a version of like an NPS score that you use, or number of transactions? What's like your guide star? We know we succeeded if we hit this number.
Yeah, it's a weird one. TVL on lending protocols is kind of an odd metric because what it measures is the total supply, and then you take away the total borrows and you get left with the TVL, which is the kind of idle capital that's left over in the protocol. So you could have let's say 10 million TVL by having 100 million and 90 million borrows, or you could have that with having 1,000 million and 990 million borrows. And I think in the latter case you would say it's a more successful protocol. But just based on TVL, they would look the same. So I think it's a poor metric measuring idle capital, but it is it's widely used, I guess. So Euler has, I think, around 100 million plus TVL at the moment. Our total supply is 450, and total borrows around just over 300. I really look to borrowing. I think that's a really good, or can be a good metric. It's really difficult with lending protocols to get things that aren't true metrics of users, because especially with tokens, as you try to decentralize, you distribute a token, and invariably that involves people coming in to try to just farm the token for their own benefit, and that can often skew statistics. It's really hard to actually measure things that are like true measurement of like organic usage on a protocol. But in the long run, I think that's a really good metric, is total borrowing. But if that's a good metric when you don't have any token mechanics at play. Yeah, right now it's really hard to see. I think addresses and usage, because like the numbers of people using the protocol are also interesting to watch. So we keep an eye on those as well, seeing how many wallets are interacting with it. I think we've had around 4,000 at the moment. So slowly we're ticking up. We launched the protocol only at the end of December, and the initial launch was really in a soft launch mode where we made it really hard for people to lend and borrow, just so that we could kind of restrict that urge of people just
control it.
just dive in and put loads of capital at risk. But we slowly, progressively started opening the protocol up and taking off the sort of the stabilizers to some extent, and letting the protocol take on more risk, but also become more of an efficient and useful product.
Nice. You'd mentioned the governance token you guys have. I would love to hear from your perspective, what design decisions you think you made represent the commitment to decentralization, and what aspects of the organization or the protocol does the community control versus which stuff still lies with you when it comes to decision making?
Yeah, the token, we've followed Compound's model, which I think is a really good sort of model case for decentralizing a protocol. So we've taken their lead with this and not innovated a tremendous amount, to be honest, ourselves. There are some interesting twists in how we do things. Some of the lessons that have been learned there, I think. Compound were distributing their token to their users that were both on the lending and borrowing side, and I think that raised some issues with certain strategies being played out by yield farmers. So one of the things we do on Euler is we just distribute to the borrowers of tokens, and so we do a single-sided sort of distribution. That has some interesting features. We think that on Compound, one thing that people were doing is kind of depositing and borrowing the same asset over and over again.
People are going to do this farm,
Yeah, exactly. So you can't really stop those kind of behaviors. It's actually really hard to distribute something potentially that has value to people without them then trying to game that system and extract that value. So it is really hard to do this in a way that can't be gamed. But I think that particular model allowed a really small subset of people to be able to game it, because actually it's really expensive to deposit, borrow. That strategy was used by people in a sort of manual way in the early days, but it really isn't that feasible, to be honest, in the long run. And so what's happened now is that really that process is occupied mainly by just a small subset of professionals who essentially can write smart contracts and use flash loans and things to try to optimize that and make it cheap. One of our design decisions there was to, rather than try to ban the process, I don't think you can ban this deposit borrow sort of cycle, because people always switch addresses and so on. Regulation as a whole, generally you always think, oh, we'll just regulate and that'll fix it, and you always end up, it's like whack-a-mole. You then create a new problem elsewhere, right? So we decided, rather than try to regulate it, we just make it as easy as possible so that anybody can do it. You don't need to use a flash loan. Just, if you want to do this, then go ahead and go for it and do it. And we democratize that process. At least then what we don't do is concentrate governance among this, or concentrate the sort of distribution at these just small subset of like whale farmer kind of folks who know the way around. So that was one challenge we've tried to solve. The other thing as well is, with a permissionless protocol like Euler, you have all these assets. You can't distribute tokens to all the markets, because people will just create fake markets that will then distribute assets, try to get more governance rights.
Oh my gosh.
And so what we do there is we limit the subset of markets that actually will get a distribution of the oil token, and let existing oil token holders vote on which markets actually get a distribution, and that democratizes that process. So right now we have 13 markets that are getting a distribution, and in the future you'll see people start to vote on which communities they think they would like to see a distribution going to, and the idea is that should hopefully democratize the process. Even if you had one big, really popular project, if everyone suddenly piled in on SHIB or something, then we have this quadratic voting sort of strategy where, if everybody voted for SHIB, even in that case, it wouldn't get the entirety of the distribution, because essentially there's this diminishing returns model built in, so that even when something's really popular, less popular projects can still get a share of the distribution.
That's really interesting. I like that. You can't just have like a bunch of SHIB like users just flood in and wreck things. That's super cool.
Yeah, each new shareholder starts to add less and less,
Yeah.
less. So it means that other people communities and other markets can come in and also get a share.
It's awesome.
Cool. I think the last question I had was just around regulation from governments. What do you guys think about regulation, and what are some policy suggestions you think would help the space grow? Things that need to be clarified, or bad actors that need to be sort of punished. How do you sort of think about regulation?
Yeah, I mean, we welcome it to the extent that we just wait to see what's going to come down. I think we need to have people making policies engage in conversation and get them involved. The technology is so difficult to wrap your head around for the first time, and it took me years to really understand what was going on. So you have politicians who have full-time jobs doing other stuff, regulators who are very busy dealing with all sorts of important stuff out there in fintech and other parts of the financial ecosystem. It must take a lot of effort to actually get to grips with this new technology and realize the nuances about how it works. And I sympathize with that challenge, because it must be quite daunting to have to do that. Just allocate an hour a day to crypto and try and figure out what should be done about it. It's really tough for folks. But I think it's there definitely are some bad actors that need weeding out. I think there are also some really amazing people in crypto, though, and that needs to be recognized more. If you read some newspapers, you might be left with the impression that it's just people buying weed on the dark web all the time. And maybe that was true in like 2012 or something. I don't know, but I wasn't around then. But that's just not what the space is about anymore. So I think I've seen some really encouraging stuff. In fact, just today, Rishi Sunak was in the UK, who's a chancellor here, was talking about actually trying to embrace crypto and creating like sandbox environments where people can come in and do stuff, and the regulators can see like really get to grips with how things work. So that seems like an innovative, like forward thinking way to approach this, so that everybody can start to understand the processes more. But
for sure.
There's so much questions of geopolitics with this, right? We don't really talk too much on geopolitics, but I know we're US based. I watched the congressional hearing where the industry leaders went in front of the US Congress. I laughed at a lot of the questions, but then I was also inspired by a lot of the questions, because I thought, oh wow, like this is very good conversation that this country's having right now. And then you have some super forward-thinking countries like El Salvador that made Bitcoin their official like currency right from the rip, and they get criticized when Bitcoin goes down, and people think he's a genius when it goes up. But it's just interesting to see there's a whole country right now that just said, no, that's it, we're good, let's do it, and just not falling behind, but slower, right? And that was one of the critiques of the United States that the industry leaders gave, that, hey, we have to regulate this or you're going to fall behind. Like essentially. So that's cool.
No, for sure.
Go on.
No, you're saying.
I was going to say, it's just that I think it's all about talking and being open about stuff, and people sort of embracing and like being open to new ideas as well, and listening. You have to do an awful lot of listening when you move into the crypto space, because there's just so much to take in. So I think in terms of moving quickly or slowly, it must be tough for the regulators, because they don't have a huge amount of time on their hands, and there's all this stuff to get to grips with. I think it's important to take stock and actually move slowly. And I know there's this kind of temptation to move really quickly and to just to sort of apply the old rules as if nothing's changed, and close everything down. But you can really risk hurting innovation at that point. And like with all regulations, it really, like I said before, you do one thing thinking you fixed a problem, and you just create a complete new problem. So I hope everybody just keeps a level head and thinks carefully about where we want what we actually want to get from the system in the future.
Cool. Okay, well, speaking of educating regulators, we're going to move to our next section of the show, which is the who to follow. And that's the WTF section. We just talk about somebody who we think is a really good educator or builder in the space. And so for my WTF for this week, I have SeanMac.eth on Twitter. He's head of marketing at Gitcoin. And he just talks about, loads of different topics related to crypto. This week he was talking about the DAOs and maybe a DAO basic income, basic wages for being trusted and verified contributors to DAOs. And so he's a great person to follow if you're interested in learning more about the space. Joe, do you have a WTF?
Yeah, this week I've been trying to build since like the beginning of time right now. It feels like that's how long I have my nose in the books. So I wanted to shout out Alchemy platform. Anybody who's getting into building or starting out, follow Alchemy platform. I'm new to a lot of these tools, but just the amount of resources and information they have for developers. I started like one little project on it, went on vacation, and I got an email from Alchemy saying, "Hey, you didn't log in. You got to keep building, man." And I just thought that was really cool that they're trying to help developers as much as they can. And their big thing is building massively scalable, reliable Web3 apps. And in the nature of some of the size of these apps that we're talking in this podcast, I thought it'd be a great opportunity to spotlight a tool for developers to use to build these type of applications. So that's at Alchemy platform on Twitter, and their website is just alchemy.com.
Cool. Awesome. Mike, do you have a WTF for us?
Let me see. On YouTube, I really like Finematics. Cool. Do you guys know that one?
No, tell us one.
They just make incredible explainer videos for DeFi in particular, 2-3 minutes at a time. And they break down really complex protocols in really simple ways for people. So you can Finematics with an F, Fine.
Oh, Finematics. Very cool. We see it.
Cool. Yeah, they're very cool videos. Another guy I used to watch is called EatTheBlocks. He does lots of little coding bits and pieces for Web3 on Ethereum in particular. I checked out his channel more recently, and he was doing a bunch of Binance Chain stuff, and I wasn't as impressed then. But he's called Julian, and I think he does. If you go back, he's just got tons of stuff where he helps people get started with basic Web3 concepts, but also some really more advanced stuff as well. How to write flash loans, how to fork protocols, how to dig into the depths of Uniswap and Compound, and so on. So. Hopefully he's still making cool stuff. I haven't had a chance to watch his things in a little while, but I used to love watching some of his videos.
Cool. Okay, EatTheBlocks, but just the classics, none of the new stuff.
The old stuff, yeah. All the underground.
His first two albums.
Yeah, that's right. I'm looking at the Finematics thumbnails. They're so cute. A little infographic like
this looks super helpful. I feel as if I've actually watched one of these videos before, not realizing it was Finematics. Yeah. These look really familiar. Like the what is DeFi? I probably watched that like a while back because these look really interesting. So I'll definitely check these out. Post links in the podcast notes. But thank you so much for hopping on the podcast today. We learned so much, and hopefully our listeners did too. Anything else you want to say right before you go?
No, I'm good, thanks. I'm gonna clock off for the day now. It's the end of the day for me. So.
Oh yeah. Time's moving on. All right, cool. Thanks so much. This is Michael Bentley from Euler. My name is Knyck.
I'm Bro.
This is another episode of the EatTheBlocks podcast. Catch you guys soon. Bye.
Thanks.